Thank you. Good morning, everyone. I'm Tracy McKibben, the chair of the Finance Committee for the New York Power Authority and the New York State Canal Corporation. I'd like to begin by welcoming all of the committee members, Chairman John Canal, Dennis Traynor, Michael Balboni, and Anthony Pacenti are both excused from this meeting today. I'd also like to welcome Trustee Eugene Nicandri, who's been invited to join this meeting. In addition, welcoming all of the NYPA and Canal Corporation staff. This meeting has been duly noticed as required by the opening meetings law, and I call this meeting to order. I think all of the committee members have had a chance to review the amendments or review the agenda and make any amendment. And I wanted to know if they have any amendments to the agenda. If no amendments, I'd ask for a motion to adopt the agenda.
So moved.
Can I get a second?
Second.
Great. All in favor, say aye.
Aye.
Okay, with none opposed, if there are no questions, the agenda is adopted. The next portion of this meeting will be held in executive session. I'd ask for a motion to conduct the executive session to discuss financial and credit history of a particular corporation pursuant to Section 105F of the Public Officers Law. If I could get a motion.
So moved.
Second.
Second. All in favor, say aye.
Aye.
None opposed. Motion adopted.
Okay,
Executive session?
we are now in executive session. Cut the feed. We are live.
Great. I would like to ask for a motion to resume the meeting in open session.
So moved.
So moved.
Second.
Second. All in favor, say aye.
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 Great. With none opposed, the motion carries. There were no votes taken during the executive session. We have a consent agenda which consists of minutes of the last 3 Finance Committee meetings, and they're now before the committee for adoption. If I could get a motion to approve the consent agenda.
So moved.
So moved.
Second.
Second.
All in favor, say aye.
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 Great. With none opposed, the motion carries. I'd now like to invite Sarah, to EVP and Chief Commercial Officer, to present the next 2 items on our agenda.
Hey. Good morning, everyone, Chairman and committee members. As you know, NYPA has supported energy efficiency projects across New York State for the last over 20 years, since 1998, when the programs initially started. We have supported the financing and implementation of over $3 billion worth of projects over the last 2 decades. These energy efficiency projects support our customers in reducing energy consumption, which results in bottom line financial savings to their budgets. Additionally, they support the reduction in greenhouse gas emissions, which support our overarching policy goals. The projects themselves are funded by NYPA to the extent that we provide financing for them during their construction process, and then there's the opportunity to either pay back a lump sum payment for the financing of those projects or enter into agreements for longer-term financing over a longer-term payback period. So the funds themselves are recoverable to NYPA. We pass through the financing costs. In addition, we charge an administration or project management fee, which is covering the cost of our project engineers that are overseeing a portfolio of projects in the range of 400 to 500 projects specifically every year. In addition, the value of those projects being implemented have increased over the time, but we're looking typically at between $300 and $400 million of capital projects annually. So what we're seeing now is the fact that our customers are demanding more from us. As you can see in the materials that were shared prior to this meeting, our pipeline has consistently grown over the last few years. Secondly, we have very strong goals that have been set out by the Climate Leadership and Community Protection Act, which is a law, in addition to the governor's policies for energy efficiency. And finally, in order for us to undertake these projects, we need to have authorization from the board to dedicate funds towards these programs and the implementation of the energy efficiency projects, as well as approval for the contractors, the general contractors or implementation contractors, as we call them, to implement the projects themselves. So it's against this backdrop that I'm here today to request specific authorization to be proposed to the board at the December meeting. I already really covered this. This just gives high-level statistics around our energy efficiency program and the fact that we have achieved savings as well as greenhouse gas emission reductions. Specifically, the contracts with our implementation contractors or general contractors are about to expire, and therefore it's important for us to be able to move forward with the program that we have these contracts in place. This is the energy efficiency pipeline. As you can see, it's been increasing again over the last few years with about $1.9 billion of projects that we have line of sight to that are either in development or in construction. As I highlighted in the beginning of my remarks, this is the structure of the projects themselves, where you can see that there are interest payments that are provided and paid back to us that support the financing that NYPA is providing, in addition to the fee that we charge to cover our labor in overseeing the implementation of these different capital projects. The customers have the opportunity to pay back in a lump sum payment or to enter into long-term financing agreements that typically then are paid out of the savings that our customers are achieving in the implementation of these energy efficiency projects. It's a non-bill financing, which helps them manage their budgets and provides a level of certainty. There are a lot of numbers on this page, but I think I would most specifically draw you to the 4th, 5th, and 6th columns. You can see that based on the expenditures and the open PO values, we have an authorization of $830 million left from the last time the trustees approved funding for these programs, and that was back in 2015. We typically are seeing a run rate of $350 million a year in project implementation, so this would be covering us for a couple more years. But based on the portfolio and the pipeline that we see, we're looking at the 5-year forecast that is about $1.67 billion, plus the run rate that we're seeing that we are expending for our projects annually. And so the forecasted spend is in the 5th column, the $2.337 billion at the bottom in the total. And so the request really is looking at the differential between what we have remaining under authorization from prior board approvals, plus the forecasted spend that we see in helping to meet the customer demand for the projects, as well as the increased policy goals and laws set out by the state, such that we're coming to request $1.5 billion to be spent towards these types of and financing these types of projects over the next 5 to 7 years.
So, Sarah,
Yep.
Just run me back a slide there. So, of the $3 billion column B, the $3.05 billion committed to date, how much of that has been actually completed? This suggests there's still open POs on that, so not all of that $3 billion is completed projects, correct?
No, that represents the specific projects that have already been spent, but the open PO values that are tied to particular projects.
Well, my ultimate question is how much of that's been recovered at this point as we sit here, or what sits on our balance sheet as a receivable, per se. Going back to the slide before that, they can either repay in lump sum or repay over term on a financing basis. So I don't know what the typical split is there. So I'm just trying to understand how much of the $3 billion that's already out has already come back to us, versus how much of that $3 billion is yet to be recovered.
Now that's a good question, and I'd have to get very specifically back to you on that. I would
Okay.
say that typically we've been funding about $300 million annually and been getting returns on the capital that we've expended for that. The majority of our projects actually are financed over say a 3 to 20 year period. Only a couple of our customers actually pay back lump sum. So I'll have to get back to you on that ahead of the board meeting.
Okay. But the punchline here is we're going to recover all of this $5.5 billion. That's the premise.
Yes.
Right. It's a massive, funding and financing plan. So we'll have recovery of as well as recovery on our investment.
Yes.
All right. Thanks.
And Sarah, one question that I had is you think about, this is obviously, this expenditure is over several years, and I know we're going to talk more broadly about what our vision is, more longer term. How does this fit into our, being more ambitious and more aggressive about the role that NYPA will play in sort of improving the clean energy adoption and moving forward in the state of New York? How does this plan fit into the broader mission or expectations around what our strategy is over the next couple of years?
So I would say twofold. One is that there are energy efficiency targets that have been set for the state, specifically for state agencies, and NYPA has, in concert with NYSERDA, identified goals and targets that we will meet in terms of reducing energy consumption from 1990 levels. And that's articulated in tera-BTUs, which is a little bit hard to wrap your head around. But NYPA has articulated supporting our customers meeting a reduction in 11 tera-BTUs over the next 5 years approximately. And there are definitely a lot of projects that we have line of sight to, but there's also still a gap that we have to fill in terms of identifying new projects and supporting the financing and implementation of those. And so that's the first, I would say, response to your question around what exists now. When we think about the Climate Leadership and Community Protection Act, that is one of the key elements of that is getting to a carbon neutral or carbon free electricity sector by 2040. Therefore, anything that we do on the demand side to reduce energy consumption and having energy savings helps us on the supply side, because then you will not need as much energy and electricity supply on the supply side. And if we're turning over our asset base to essentially get to 100% renewables, recognizing you're pairing with storage, et cetera, it's enabling us to do this in an ever more cost-effective way. Your question? I can't hear you.
Sorry. Yeah, it does. It's helpful. So, you've sort of, if I understand what you've said is, it puts us in the direction of meeting the commitment that we've made, joint commitment we've made about how to reduce, I think you said 11 tera-BTUs. And so how does this, because this is a plan for several years and that commitment's over the next 5 years, how much closer does this get? I understand that there's still more work to be done, but this gets us in terms of what our expectations are and how we measure that we're meeting these goals that we set. This gets us how close would you say to that goal?
I think the 11 tera-BTUs. Yeah, I mean, 11 tera-BTUs is a very large number, and so we have to. A lot of the projects that we've already done in terms of energy efficiency, we've picked off the low-hanging fruit, LED lighting conversions, et cetera. So a lot of the work that we're doing now is much more capital intensive. It tends to be deeper energy retrofits, boiler replacement, HVAC system upgrades, and so that requires a significantly greater amount of capital than some of the other low-hanging fruit, like changing out light bulbs. So I think that this puts us well on the way. However, again, if we look at the continual customer demand, and as we also do greater analysis as to which projects will get us the biggest kind of bang for the buck when it comes to energy efficiency and energy savings, we may need to spend more, but currently we're taking a relatively conservative approach in recognizing the amount that the organization annually has been managing in terms of the size of capital project budgets. And it should get us, through the next five years in a reasonable manner.
Great, thanks.
I need a motion for this, Tracy.
So, yes, I'm
Yes, I guess we
recommending
do.
to the
Yeah.
trustees to
If there are no other
authorize the
questions,
1.5.
I'm happy to move the requested action for the additional 1.5
Can I
billion.
get a second?
Second?
Great. All in favor, say aye.
Still in favor. Aye.
Aye. With
Aye.
no opposition, the motion carries. Thanks, Sarah. Next
Great.
on the agenda is Joe Sorry.
I have one more item.
Oh, that's right. Sorry.
Right.
Go ahead.
So in addition to the program funding authorization that you just motioned to provide to the board for full authorization, we have implementation contractors that support us as general contractors in managing these construction projects. So the 1.5 billion would be used specifically in the contracts that I'm going to request to be allocated and awarded to the contractors in this next item. Back in May 2018, we launched a robust process to procure a set of vendors who have the technical and commercial and competitive pricing qualifications to conduct a range of services across the state. And that is in order to, going back to your prior question, enable us to work ever more quickly and effectively to meet the goals of the state. By having a lean, qualified vendor pool, we can either mini bid out for very specific projects that come up, or we can allocate and assign to particular vendors based on predetermined pricing structures that have a level of transparency to them. So back in May 2018, we launched this process and went through various bid conferences, first round qualifications, final round of submittals, and the number of suppliers that had initially expressed interest was 57 at the beginning, and that dwindled down to 23 suppliers providing submissions specifically for the services that we requested. I already touched
And we're now
on.
looking at, sorry, go ahead.
So as I touched upon, the criteria was robust from a technical and commercial standpoint. In addition, we had requirements for the different regions that were set out across the state that we had representation from minority-owned business, women business-owned, as well as veteran-owned organizations. This map demonstrates the 4 regions and the contractors that are being recommended to be awarded. In some cases, we have contractors that the blank white spaces are not necessarily because contractors were not awarded in that area, but they didn't submit, because as you can see from a geographical layout, down in Westchester and the lower Hudson Valley, Long Island, there are some businesses that just choose to work in those areas and not to provide services across the state. But again, in order to get the best vendor pool, we essentially divided it into 4 regions and enabled individuals to just bid, the companies to bid into the regions that they preferred. As a result of this, we expanded the vendor pool from where we had received previously, and so now we have 3 new vendors in the program that have never done work with NYPA. So the specific request is to award 19 contracts for the implementation contractors to provide these delivery services across the state. Did you have a question?
Yeah, my question was, I saw that you, obviously, we started with 23 who'd responded, and then we narrowed it down to 19. Is there, and the reason why the 4 were, because the 23 was a reduction already of I think it was 57 or 50 some, mid-50s that you had said
Right.
began in the process. What was the reason for those drawing out? And I assume all the considerations, as you mentioned, around minority-owned, women-owned, veteran-owned. Any additional insight you can give us on why the number dropped?
The specific panel that was put together, weighted all of the submissions, and if they were not able to meet, say, the specific requirements across any of the areas, they would not have been able to move forward. I can provide more detail on why those very specific ones fell out, but again, as you know, with the procurement process at NYPA, it's very robust, and again, our goal was to have a comprehensive and as large a vendor pool as possible to work on these projects. And so, if they were not approved, it would have been for them not meeting specific qualification criteria that would be needed.
I'm happy to
Any other
move
questions from
the
the-
recommendation to award the 19 contracts, Tracy.
I
Great.
second.
With the motion to approve the award of the services contract, can I get a second?
Second.
All in favor?
Aye.
Say aye. Aye. With no opposition, the motion carries. Thanks, Sarah, for your work
Thank
on
you.
this. Now I will turn to Joe, who's the EVP and Chief Operating Officer, to present the next 4 items on our agenda around our utility operations capital expenditure.
Thank you, Finance Chair McKibben, trustees, and staff. Welcome. I'm just going to touch on these briefly. These are all projects that you should be familiar with from some previous, but I will give you some context from previous meetings and outlay what we're talking about today. So the first item is the Moses Adirondack project. This is one that we have talked about frequently. This is the 78 miles of one of our oldest assets in our portfolio of wooden pole structures that we're looking to reconstruct. This item has been brought before the board on a number of times. The scope of the work that was authorized by the board in its entirety in terms of the project is $483.8 or roughly $484 million. We have awarded certain contracts that are along the process around engineering services and studies and so forth throughout that. We've had capital funding currently authorized by the board to the tune of $142 million. And today, what we're here to do is get the authorization for the balance of the capital funding to that amount of near 484, which will go into the actual construction contracts that are going to be going into place. It should be noted, too, that between the time we submitted these materials and today, we actually did get the Article 7 approval from the New York State Public Service Commission. That's a great undertaking. That's a great achievement. It greases the skids for the project in terms of the public outreach going forward. So that's a big accomplishment by the team. This is just a backdrop of some of the history. This is in the materials, but I'll just brush on it real quickly. It talks about the original scope being $450 million. Through the process and this iterative review by some of the regulators, the scope had changed and some of the escalators had changed based on the timing. And you had already approved back in 2018 the 484 for the release of those capital funds in terms of the entire project, not specifically the contracts we're looking at place. And through this meeting, up until this meeting, you have, again, kind of awarded $146 million worth of that work that's in play right now. We kind of had to get creative in terms of the timing here because the traditional design bid build for a project like this, especially recognizing that it was in front of a lot of the regulators and oversight, what we did is pre-qualified contractors for this work originally. So we had 15 firms that we actually pre-qualified originally, and of those 15 firms, and that judgment was based again on a panel process. It talked about the commercial terms, technical expertise, their capacity to do the high voltage work, and of course all the other benchmarks that we need to meet in terms of NWBE and veterans of contractors. And of those, we did submit for request a proposal of 6 qualified vendors. 5 responded to that, and those are currently under evaluation, and we expect to bring a recommendation to the board based on this approval in the January trustee meeting for the actual contract for this work. This next slide is basically just tracking the contract costs. It looks pretty uniform, and that's because it's pretty linear work. It's not like some of our other capital projects, which have specific scopes that have large chunks here and there. There's some study up front and so forth, but then you'll see that based on outage schedules and so forth, that it's going to be pretty linear work from the time they start construction next year into 2023. And all these costs would be recovered under our FERC-approved formula rate.
All right, so Joe, just to clarify, so you're asking us to authorize approval of the 341, and you're going to have specific contract awards back to us in January. So we're going from authorizing the 340 to having specific contracts to approve by January. Am I hearing that correctly?
That's correct.
Okay, got it. I'm happy to move this.
I think we're going to move them all together. Joe's going to go through. He's got several projects, so we'll just do them all as a group.
All right.
Okay.
Sorry.
I'll move on to the next one. This one, again, is in part of our smart G&T. This is our comms backbone. So we've talked about this a number of times, that we're installing fiber optic cable and networking all of our assets together through fiber optics and microwave links. This is just a continuation of that project. The history behind, am I the right one here? Yeah. The history around this one is that you originally authorized about $50 million of work to do this work. We then decided that it would be, under the digitization strategy, time to expedite and accelerate and actually expand the scope a bit around redundancy and some of the technical capabilities of this work. And you had previously approved the entire project portfolio of $153 million. To date, the capital funding that you authorize is $100 million. This is a request for the additional $52.72 million. That, again, will be tried to complete that through 2021. We also need outages on this, so that schedule could be dependent on a couple outages and impacted by that. But if everything goes well, we should be completed in 2021 on that. Again, just in terms of background of the timing, I misspoke. It was $39 million was the original scope. It was 153 total. We've authorized over 100, so we're after the balance, which is about $53 million to 52.72. And again, multiple contracts, materials, construction, and personal services have been approved under the original authorization. And again, we'll give you the project scope in terms of the schedule. And we are confident that with the if we get the outages we need, we'll be able to accomplish this in 2021. And again, these are also in large part rate recovery by our FERC-approved formula rate.
Joe, just so I could make sure I understand, because if I read this correctly, the original estimate was $39 million, but we authorized $100 million, and the estimate then got moved to 153. Help me understand how we went from 39 million to 153 in over a year. What was the original estimate? It was based off of what? What portion of this?
The original estimate was, in fact, I'm sorry. The original estimate was actually around $39 million. The scope is what actually changed. We came back to for the 153. So the original estimate was to connect everything in a rudimentary way to get the communications back. During that time frame is when we emphasized our digitization strategy, implemented and activated the ISOC, and started our sensor deployment project at the same time. So realizing not only that we needed additional capacity for communications, but also the redundancy associated with that, we actually increase the scope of work. So the additional scope that goes up to $153 million is actually additional scope of work. It was not a bad estimate. It was actual change in scope of work to get to that 153, expanding and accelerating the capacity of the installation.
And when was
Okay,
the
great.
and
Same
you've
as the
already
last
actually approved-
conversation we had around.
I'm sorry, go ahead.
No, go ahead. No, I was just saying, it's
And
similar
actually, on
to the Moses
153
Adirondack conversation.
Right. You've already approved the 153 and as terms of the overall project in previous meetings, and actually up to $100 million in authorization on spending of it in previous meetings. So this is the additional $53 million associated with that.
Great. Sorry. I think we were talking over each other. And I was just saying that similar to the Moses Adirondack discussion we just had, this was also just a scope change of what we ultimately expected we were going to do, right?
That's exactly right.
Okay.
And when
Great.
we have
Any
the
other
specific,
questions?
when we have the specific contracts on this 53 million, Joe?
Well, these will have to come back as well. They're rolling right now. These are rolling contracts, so we're going to have those back in front of you as well as these get authorized.
Which will happen, in the near term or progressively
Very near
over
term.
the next year, you're saying?
But, very near term, first quarter of this year,
Okay. Got it.
2020.
Thanks.
So that'll be the requested funding for $52.72 million. And if you're okay, Chairman McKibben, I'll move on to the next one.
Okay, go ahead.
So this one is our longstanding life extension and modernization program. This is a part of that up in the St. Lawrence region, the relay replacement program. So again, this is you're very familiar with the $726 million that's been going on now since I should get my talking points, make sure I got the dates right, but I think about 2012. And so the total, this part is the relay protection and other associated equipment with the Robert Moses Switchyard up in Messina. The total program estimate for this was $110 million, and the capital funding currently authorized by the board is $65. The current capital funding request that we're asking for today would be $44.2 million to round out the balance of that work. This work is continuing to be on budget, and the revised schedule is to complete in 2021. It's outage dependent as well. You may recall we brought to the board this kind of extension of the scope of from a timing standpoint based on the complications of outage. This is kind of a working on some of the older equipment and transferring some of the lines directly. Our staff is doing a lot of this work, so you had previously authorized the extension. So this is on track with that new authorization that you did. So I was right without my talking points. 2012 is when we started the overall project to $726 million. This program we're talking about here represented an estimate of $110 million of that up in Messina, and the project scope and schedule changes to date have been already authorized by the board, and multiple contracts for material construction and personal services were also authorized by the board to date. So this is where we would be, and we're asking again for the project spending to include the proposed four-year budget, financial plan, and payment associated with the program to be recovered under the authorities for approved regular formula rate, similar to the other two projects, same mechanism. So in summary on that one, it's recommended the approval of capital expenditures in the amount of $44.2 million to complete the St. Lawrence breaker and relay replacement. You may also hear us say bar once in a while. That's what we refer to, program for the Board of Trustees for the December meeting as well. Any questions on that one?
Great.
Okay.
Continue?
Smart generate. I'm sorry. Go ahead.
No, I was saying you can continue.
Okay. Smart Generation Strategic Initiative Advanced Power Flow Project. So this is part of Smart G&T, so one of the strategic initiatives. It's advanced power flow control solution can be dynamically increase and decrease line reactance. In summary, what this is, and we can get into the technical if you want to, but basically it's our ability from a transmission perspective to control flows on a less burdened line to increase our capacity to move energy throughout the system, push and pull that way. So this program had a total estimate of $12 million in capital funding that you've authorized currently is about $500,000. We're basically going after the balance of that capital funding request of $11.5 million. Again, based on outages, it's associated again with the transmission work. We're currently on budget and scheduled to be completed in 2021 on this as well. Project costs are summarized on this sheet. It's a proposed four-year budget and financial plan. And payment associated again is through the authorities FERC approved formula rate. So all of these are kind of what I would qualify as generally as transmission projects. So they're all recovered in large part to that formula rate. And the request there would be recommendation for approval of capital expenditures in the amount of $11.5 million for advanced power flow control project. And I'll take any questions on that one.
No questions.
Great. If no questions, Joe, you're going to have a lucky day. I think we're looking at 4 different requests that total approximately $450 million. If there are no questions, I'd ask for a motion to recommend the adoption of the 4 items he just presented to us.
So moved.
So moved. Second.
Second, all in favor, say aye.
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 Great. With none opposed, this motion carries. Thanks, Joe. I think
Thank
you also
you.
have the next item on the agenda.
That's correct. This one's just for information only, to update on the project program construction management of on-call services and contract awards. So we have on-call retainer contracts to provide a pool of resources to support internal staff on a needed basis. So these are to supplement our own internal engineering resources and increase capacity for us. The examples of what we would use this for are some of the projects that we just talked about, Moses Adirondack, some of the TLM work, also Next Generation Niagara, which is the new capital project that we talked about in Niagara last board meeting, comms backbone, and of course sensor deployment, which is also integral to the whole digitization strategy. So this is the basic idea around these is just to give us capacity and resources in aggregate to improve our ability to deliver these projects in a timely way. We do have, just for the benefit of the board, a strict evaluation process for these. We did, in June 2019, had a request for proposal, which we had 25 proposals received. These proposals were evaluated again on a cross-functional basis. We try to make sure we got a nice representation from everybody in the organization. So, of course, cost is a factor for us. We want to look for the best value. The technical competence, some of these are specialists. We do have a lot of specialists in our own staff, but there are certain studies and so forth that we need a little bit deeper dive. These resources provide for that. And of course, we always compare for the metrics for the MWBE and also for the veterans participation. They have their own capacity of ability to do this work. There's an enormous amount of work, as you're aware, going on, so we try to make sure that we factor that in, their ability to deliver for us. And of course, the relevant experience either with us or in the industry to make sure that they've done similar kind of work and understand the nature of what we're trying to do. So the next step will be at the trustees' December 2019 meeting. Value contracts for a 5-year period of aggregate amount of approximately $100 million will be presented for approval. And those will be those individual mini bids that are underneath that will be all within the confines of the existing budget of each of those individual projects and/or the O&M budget. Any questions on that?
So, Joe, just so I understand, are these people that we want to bring on in special circumstances as we, sort of perform or pursue the programs that we've laid out? Is there sort of emergency services, additional capacity that we might need on individual programs or projects, right? That's what this is?
Yes, exactly. So, just by way of example, if we need a specific technical resource in civil engineering for the constructability of a tower or something like that, we lean on one of these contracts to provide that technical guidance for our staff to fully vet that or even do design work under those criteria to make sure that we're designing those things properly. We have, of course, as you know, civil engineers, electrical engineers, and the whole engineering staff on board, but with the size of the capital work we're doing and our ability to look for specialized, if it's a monopole design and we don't have that competency in-house, we can go to one of these resources that has that competency to give us that assurance that we're getting the right design there.
And we have an estimate of the dollar amount that we think that's going to last, and this is for several years, but we don't know how many people we're expecting we might need to fill in these capacities. We won't know until after, we're into the program or into the project and see what we need. There's no number of heads that would be included in this number.
Well, what it would really amount to is our own resource loaded schedule and what our own engineering needs would be for each individual project. We do have an idea what those numbers are. And this is actually, if you take that number and subtract what our capability is in-house, this number would represent the balance that we'd have to use to achieve those other targets in the resource loaded schedule. So if I know I need, and I'll continue to use civil engineers as the example, if we have 3 civil engineers on staff, but I know by my resource loaded schedule that I'm going to need 10 civil engineers over the next 5 years, this $100 million will allow me to tap for those other 7 FTEs of resource without going directly to staff, especially if they're specialized areas. And the constraints on that spending are really within the project budgets and the actual capital and O&M budgets that we put that Adam will be talking about. So that's how we constrain the actual spending on those is through the budget process.
But staying with your example, you mean you'd obviously look at whether or not you should be adding FTEs versus outsourcing this, right? If you need 10, you've only got 3, you'd evaluate the pros and cons of adding some combination of additional civil engineers rather than just outsourcing, right?
That's exactly right. So what we found out is that if we have, since we're doing a lot of capital work, is that there's work scopes that increase in our capacity and then go back down. But if you run a series of those together, at some point what you recognize is that the staffing actually has to be adjusted to do that. So that's actually how we do some of our requests for the budget process for internal resources. But outside and beyond that, because some of the scope is dynamic in terms of the specialty work, you don't want to have a specialist on staff for 30 years if you need them for 1 year, that kind of thing. So we make sure we use that for those types of purposes.
Thanks, Joe.
There's no other questions?
Great. Thanks, Joe.
Thank you.
Right, and no votes required on this item. Next on the agenda is, Adam, you're going to talk us through the 2020 budget and 2020-23 financial plan.
Yes. Good morning. So we're going to walk through the financial plan, just try to hit on all the high points. I know that you've all seen the material and gone through it and had opportunities to ask some questions, and obviously we'll have some more dialogue as we get between now and the full board meeting. Major takeaways for this plan is that it fully funds our core business, including canals, and as we look at the capital budget for canals, we'll look at that as we go forward with future plans of canals and adjust accordingly. It supports all of our capital projects, O&M related to our corporate strategy, which are consistent with state energy policy, and you'll see in the slides that our revenue growth will outpace expenses, which will show growing net income over the 4-year period. And it maintains our financial performance consistent with all the metrics to maintain our AA credit rating, which is very important for us in order to maintain our capital program and do all the things that we need to do. Also, there's been a focus this year on controlling costs, both to remain competitive and deal with the fact that we're in an environment where energy prices have gone down and we have some shrinking margins. Today, we're going to be asking you at the end to request to approve a recommendation to the full board in December for the approval of the plan, both the NYPA and Canal's O&M budget, capital budget, the energy services capital budget, and the posting of our 4-year financial plan. This year, the only major changes in the actual budget process itself is really that the gross margin was generated from the new models that we're using in ERM and Sarah's group, which is a probabilistic model using stochastics and Monte Carlo simulations to come up with not only a forecast and a projection, but sort of a confidence level around that projection so that we know what the range and the risk is. And that was sort of sanity checked by our finance and model that we've used historically, where we've tried to make sure that we understand where the differences are, if there are any. And this year there really weren't many, but I think we'll get back to you and show you how what the two models presented and why there were differences between now and December. Also, what we've done in the budget is that for the new initiatives, a lot of our startup businesses like EV charging and the energy management system, and all of the different new startup businesses that we're doing, we're going to have separate P&Ls for those businesses in the budget so you can see on an ongoing basis how well they're performing, and we can make decisions going forward if they're tracking to plan or not. And then we'll be, setting up this plan as an end to the NYPA 2020 plan and setting us up for the Vision 2030, which we'll be discussing later with Eve in this session for the Finance Committee. Just in terms of where we are this year, the projection going into this year was to be at $20 million net income. We're looking to end at $31 million, $10 million approximately better than forecast. A lot of that is resulting from sort of below the line items such as interest expense, which is lower, and then the mark to market our investment securities. The margin business from generation is down about $27 million. That's been offset by higher transmission revenue and non-utility revenue than was expected. The non-utility is mostly from the customer energy services business. Operating expenses were higher than forecast. The major drivers of that were depreciation, plant and service happening earlier than was expected, as well as pension and OPEB expenses related to salaries and benefits. and those we hope will smooth out in the next year. Over the forecast of the 4-year period, we are projecting $41 million for next year's net income, growing to $94 million over the period. And on the right side of the screen, you'll see that it maintains all the targets and metrics to maintain our AA rating. The growth of the $41 million to the $94 we'll get back into later in the slides. A big driver of that is our transmission revenue, which Joe was talking about, which is subject to the formula rate. What this enables us to do, this generation of additional net income, is allow us to generate the cash to be able to have a capital program going forward to support the new strategic initiatives and maintain that AA credit profile. So this is why it's important for us to have a growing revenue and certainly beyond the growth of expenses going forward.
And Adam, if I could just interject, that increase of net income and cash generation is also going to be important as we move forward, because we anticipate that we will be investing more in initiatives to support the CLCPA, the Community Climate Leadership and Community Protection Act. Obviously, our NYPA 2030, you'll hear more of that from Doug and Eve a little bit later, our vision for what NYPA will do between now and 2030. And also, we continue to work on reimagining the canals. You have heard about our efforts on that during the past. So between now and our annual meeting in March, we will refine those numbers and come back to you with specific, targeted investments in those initiatives. But it's important to note that we will keep the rates of our customers low and competitive. That's always been our bread and butter here in New York, and spur economic development, while at the same time making those significant investments to meet our state's greenhouse gas emission goals, our vision for NYPA 2030, and reimagination of the canals.
Thanks, Gil. Also, just real quickly, just to sort of level set things, last year, this time, we were projecting next year's income would be, for 2020, $49 million. This year, that number is $41 million. And you can see the major differences here is really the effect of the lower prices and the lower forward curves that our revenues are projected on, offset by higher transmission revenues than we had expected last year, and then a depreciation expense rising by $11 million from what was projected last year. And as I mentioned, as depreciation expenses go up, that is ultimately a good thing because there is a lag, but we will see that in increased revenues going forward. And with respect to the transmission business, a return not only of that investment, but on that investment of 7.25%. Just in terms of the 4-year forecast and the trends, actually, I just want to go back and make one other point. So if you do look at what we projected last year, it's an important point. If you look at the total operating expenses we projected last year was $711 million that we would have in 2020. This year, coming into the budget, we really made it a point of trying to keep our expenses low and steady, knowing that we had these headwinds of energy prices. So we actually came in a little bit under what was projected last year to keep the expenses very low. That enabled us to get close to that target of $49 million to 41. The trend over the next few years, as I said, was going from 41 to 94, and as you can see on the graph on the lower right, it just shows the growth of expenses in the bottom, the growth of the revenues on top, and shows that widening margin from the EBITDA standpoint. That means when we say EBITDA, that's earnings before interest, depreciation, and amortization. It's sort of the cash that's being generated by our underlying core business. Again, that's that cash that allows us to maintain our capital investments going forward for a strategic plan and to maintain the upgrade of our system. The merchant margin this year, if you go to the top, we project the merchant would be $335, the customer revenue $551, transmission $171. And you see how that transmission number will grow over the course of the plan. That's up by $80 million. We'll see a graph on that in a little bit, but that's a main driver of that revenue growth over the 4 years. The 335 is based on the modeling that is done by the ERM. So that 335, we see it's growing to 363 and then sort of levels off over the 4-year period. But this is the range of risk or the level that we believe it will be within. So there is a 95% probability that we will do at or above the 265 and not go below that. And then the top end of that range is 414. But the target that we've set this year with Sarah and her group is 335. And we will then employ a hedging strategy as we see appropriate as we move forward in order to fully solidify that number and reduce some of the volatility and risk on the downside. Just in terms of what's changed between this year and last year going into the plan, this just shows basically what's happened. The blue, light blue, is this year's forward curves. The dark blue was what we had last year. And the capacity price is the same thing, the light blue versus the dark blue, and hydro generation. So we see the full curve moving down this year, which put a pressure on our revenues. Capacity prices spike a bit because of shortages in New York City, but as new capacity comes online, we see that being alleviated and coming down right after. Hydro generation ended up being a lot greater this year than we expected last year, and we see it staying at that level for the near term, but a reversion to the mean as we go forward. But again, if you see the yellow line below, that's the long-term average. So we still remain above the long-term average in terms of hydro flow. And this is a very important metric for us because this is really the driver of a lot of our revenues out of our hydro plants. As far as O&M expenditures go, going into this budget process this year, we knew we would have some challenges because revenues were lower. Gil made it very clear to senior management that there had to be a focus on keeping expenses controlled and low, and perhaps reductions were necessary in order to fund our initiatives. So we're able to fund our initiatives and maintain pretty solid in terms of the O&M. And between this year's final and next year, we're going to increase O&M by 2.3%, which is roughly in line with inflation. And embedded in that are a lot of some savings. One of the big parts of savings that we did see is that our maintenance for our facilities is actually going down because of our capital investments that we've made in the asset management associated with the ISO 55000. So we're seeing some benefits from that going forward, which has helped us reduce our costs and maintain stable and be able to fund the initiatives. Again, O&M expenses broken down by generation, transmission, headquarters, and customer services. Here's some of the changes from year to year. There's a 1% increase in salary and benefits, which is pretty low. Some of that is relief in the benefits because we expect the OPEB not to be as great as it was this year, so we're seeing some reduction there. Overall, salaries are projected to be 3% higher next year than this year's final. So that includes union contractual wages, promotions, new hires. All of that is factored in. It's within 3%. But given the benefit reduction, it's at 1.2%. And then we have increases for some of these strategic initiatives, as you see, Evolve and Backbone and NIAM and various EPRI initiatives. So all of those can be funded with the reductions that we're able to receive. And in addition to the process this year, knowing that things could also change during the year, we had the various departments prepare contingency plans for a 5% reduction, 10% reduction, if in case we needed to employ any of those going forward should something unforeseen happen that was unplanned. In terms of capital investments, this is just kind of driving home that point on the driver of the revenues throughout the plan. It's really in this transmission area. If you can see the investments going forward on the left, and then on the right is the revenue that we will get associated with that. So you can see that going from 238 million rising to 320 million. That's an $80 million increase in revenues. So that's a major driver of our increased profitability over the next 4 years. And this is just the capital expenditures that we expect going forward over the next 4-year plan, and we'll be putting together a financing plan to support that, both using both bonds and cash generated from our business. This is the total capital plan for the 4-year period, $3.4 billion. As we mentioned earlier, depending on the plan for canals, we may come back and revisit that in March of next year, but we believe that we will have sufficient resources to meet any of the capital investments that we decide to make. And this is just what's going to happen next year, $864 million in the breakdown between headquarters, generation, customer services, and transmission, broken up through the pie chart, different major projects that you see, many of those that Joe was just talking about earlier. And if we look at it a different way, just in terms of our portfolio, the point here really is that 70% of our capital is going into strategic programs to improve our system, improve our strategy, and meet our goals. And then we have other essential type of investments, which is 11% of the portfolio, and then some other non-operational infrastructure, IT support, the digitization, the DTO efforts are also included in the strategic initiatives. So what we're asking for today is that that the Finance Committee approves a recommendation to the full board to approve the 2020 O&M budget of $519 million, the 2020 capital budget of $537 million, the 2020 energy services budget of $257 million, and the posting of the full 4-year financial plan on the various websites and with the various state controller and other public authorities' offices that are required. Certainly would open up for any questions for today, and certainly between now and December, both myself and staff will be available for any additional briefings that are necessary or any additional deep dives that people want to go through.
So at this point, Adam, you and your team are comfortable, you've mitigated, compensated for what I'll call were the misses in last year's plan as you look forward, correct? The energy, prices and other, market volatility, you feel all the more comfortable, confident as you sit here today, looking ahead 12 months, given what you now know, looking back 12 months.
Yes, I believe that we've used a lot of the experience from this year as we incorporated into next year's budget to try to be a little more conservative, try to reduce volatility where we see it, and try to de-risk the income statement, and certainly utilizing as we go forward hedging strategies to further mitigate downside risk. But we have been conservative in our approach.
And I guess, Adam, one question that I had is we looked at where we think we'll end up for 2019. A lot of and we're sort of above plan, or we exceeded plan, but a large part of that was not necessarily because a large increase in our operating income. It was more the impact of where interest rates ended up going. Is that right? And so,
that's correct.
If that's correct, right. And so as we've looked at what our expectations are with, for going forward over the next 4 years, 2020 through 23, that doesn't figure in what might ultimately happen with interest rates if they were to, continue to go down or to go up or what have you. So you haven't even figured in the impact of that toward our income expectations.
Well, we've been conservative in terms of not relying on any of the additional interest income that we had in last year. And we do see some expense savings on the interest expense. As we go into the next items, we're going to do some refinancing now, and then we're going to do a longer-term financing next year. So we hope to lock in long-term low rates to solidify that part of the budget process and reduce the risk of interest rates going up in the future. As far as on the misses this year of the revenues, the real risk is in our merchant business, where we can have a lot of volatility based on price movements, demand, capacity, et cetera. We're just trying to be smarter about how we forecast that and how we hedge that risk. We feel very confident in the increased revenues from generation, from transmission will continue because it is a formula rate, and we think those numbers are pretty solid. And if you see, even on the expense side, when you look at O&M and how we came out this year versus what we projected, we came in very, very close. So I think we have a good handle on how to forecast that part of our expenses on our budget. But there are things such as the pension expense and OPEB that is subject to some market volatility because it is subject to how the stock market performs. So that's always going to be somewhat of a risk. So that's where I see the most of the volatility, things that are external to us, such as how the market does or where energy prices are moving. In terms of our merchant capacity, that's where we're subject to sort of a lot of volatility, and that's where we just need to be a little bit smarter about and try to hedge that.
I mean, I would just articulate that, that moving to the probabilistic model is to provide a range, right? There's an expected value that's taken in a point in time as a snapshot date. We don't have control over the market prices, right? So we have a robust hedging strategy that annually that we present to the Executive Risk Management Committee. Again, it's dependent on ultimately whether or not you can transact and the level of liquidity in the market. So the volatility around the merchant gross margin is not going to disappear. Again, we will look at locking in and protecting the downside risk as much as possible. The $335 million actually is one of the highest snapshot dates in the last couple of months. So if anything, it's on the aggressive side. But I think that that's where, in what Adam was saying, by getting a handle on the levers we have on the O&M and trying to hold our expenses flat and having contingencies of 5 and 10%, we'll have things that are actually truly within our control to manage if the market prices are not realized based on the forwards as of today.
Great, thanks.
And just clarify, Adam, for me. So in the 2020 plan, well, we always appreciate the collective focus on cost management, expense management. All of the strategic initiatives are fully funded, correct?
That is correct.
But as we look out in the remaining 3 years, not all the strategic initiatives have been fully baked or fully identified, so costs associated with them aren't fully included in that forward-looking plan. Is that an accurate statement?
Yes.
That's correct.
That's correct. So,
Okay.
and as I mentioned, we'll talk about the other items. We're going to try to develop a long-term strategic financial plan that will have the capacity, the capital capacity to finance not only the strategic initiatives, but what comes out of our 2030 vision plan. So that's going to be married with that plan. We'll come back to you in March at that time. And when we talk about all the things we want to do, we'll be able to tell you how we're going to pay for it.
And the reimagine the canals.
Yes, in the reimagined canals.
Yeah, because at this point, canals seems to be more of, my words, a placeholder until all of that is further defined and clarified. Is whether you agree with my term or not, I mean, that's a correct interpretation?
Yes, that's correct.
That's correct.
Okay. All right, but again, nothing's at risk for the next 12 months from a planning standpoint in terms of continuing to to push forward aggressively with our strategic initiatives.
Yes, that's correct.
Okay.
Great.
I mean, I appreciate
Thanks, Adam. Go ahead.
So I just think
No,
we
I
need
just
to
say I
have
appreciate we've all
a
had time to
vote on
grind through this.
the recommendation to the full board. for the,
All right, with that, thanks, Adam. I entertain a motion to recommend the NIPA and Canal budget resolution to send to the full board. If I could get a motion.
So
So
moved.
move. Second.
Second.
Second. All in favor, say aye.
Aye.
With no opposition, the motion carries. Adam, okay, you've got the next item for us about the RFPs.
sure. But just before I go, I just want to say thank you to not only my staff, who I think did a terrific job this year trying to pull things together and get this plan in shape, but really with Gil's sort of leadership and guidance to the senior management about trying to keep the costs controlled, but the various agencies and the senior leaders around the table have been incredibly cooperative, understanding the sort of collective mission here and the goal to have a budget that's balanced and that can achieve our strategic goals. So this is really a good team effort. So I appreciate everybody's participation on that. Okay, next item.
Great.
So just as an update to the committee, so we have a few RFPs out. One is just to have a liquidity facility, just to have banks available that we can go to if we have something that comes up that we need additional financing and support for. We want to always have a lot of arrows in our quiver, so this is just a good housekeeping thing that we want to have ready to go. We have a financial advisor RFP out. It was modified and then reissued. We hope to get responses in, and this would be for trying to find a variety of financial advisors, whether it be offshore wind or a solar project or any kind of strategic advice that is going to be required as a result of the strategic planning process. So any type of expertise, we want to be able to have a stable of financial advisors that have, subject matter expertise that we can call upon when needed. And then we are looking to we have to do a new underwriter selection process because the one that we had has expired and gone stale. And as I mentioned before, we are looking to get into the market next year with a long-term financing to lock in our capital plan going forward. We think where rates are very attractive now, and we think that locking in long-term rates to finance our plan going forward would be an ideal thing to do. So in order to do that, we need to go through this process of selecting an underwriting syndicate to do that. So just want to make sure that the committee is apprised, because I will be coming back probably in around January for some authorization for awards, and hopefully try to do this as soon as possible. In the interim, we are looking to refund today some bonds that are outstanding from the 2007 A and C series. These bonds have been callable since 2017, and they're paying about 5% interest. We can take these out today with 2% interest, achieve a 24% net present value savings, achieve real dollars in the budget that we are already trying to plan on for next year. And this will also just be a bridge to when we do this longer-term financing. But even if we're going to do a financing between now and the end of the first quarter, getting this done today will save at least $1.5 million in interest expense. So just to have 5% interest out there when we know we can be doing that much cheaper just doesn't seem conscionable today to me. So I think we should try to take that out as soon as possible. And this basically just follows up on what I was saying. So what we need to do today is we need the trustees to recommend to the full board to allow us to use Series 1, 2, and 3 of our commercial paper to refund these outstanding obligations so that we can capture some of this interest rate savings we can get today.
So Adam, just so I understand, you're asking us, we'll use this to basically refi sort of higher interest bonds that we have out there, and then you've laid out the plan to go out early first quarter of next year to find advisors for us to put together a more longer term financing plan.
That's correct. So this is sort of a bridge financing to get to that. So we'll capture some savings now, and then we'll we'll roll that into a longer term financing that will also capture all of our new needs going forward, so that we can again lock in some long-term rates and achieve some savings and finance our capital plan at the lowest cost possible.
mean, we've periodically done these refis. Adam, is there anything else on the balance sheet that you're taking a look at in terms of refinancing beyond what you put in front of us?
There may be some other bonds that we can take out as well and refinance or restructure that have some sort of lumpy prepayment schedules that we can smooth out, create capacity for our plan going forward. So that'd be a whole restructuring as part of this longer-term financing. And as you saw from the commercial customer energy services presentation Sarah made and the needs there, the big effort I'm trying to get now is to figure out how to get all of that debt off of our balance sheet and finance that off balance sheet and off the credit of our senior lien debt, which would also free up capacity for other NYPA capital projects. So what we're looking to do is have those sort of lease obligations pooled and sold as that pool based on the underlying credit of our customers rather than utilizing NYPA's credit. So if we can do that, we can free up a lot of capacity, not only to do our projects, but to meet this pipeline that Sarah was talking about of 1.9 billion of demand she has going forward. And we think that, if anything, that number is going to continue to grow if the governor comes out with a new executive order pushing on agencies to even do things quicker, faster, and more aggressive. So that's a major initiative that we're undertaking today as well.
So it create a special purpose entity or something similar to that, or?
Yes, that's correct. It would be similar to sort of a CLO kind of concept.
Yeah.
We have
Okay.
the authority in our statute to do special project financing funds. So basically, we would say that the revenues of our customers would be solely used as the only purpose to pay off the bonds related
Right.
to those,
Right.
and not have any claim on our first lien revenues. So that would certainly allow us the capacity to do more of both for NYPA and both for
Sure.
our customers. And our rating agencies, we've been in to discuss this with them, and they have applauded this effort, so they've encouraged us to move forward as
Great.
well.
All right, super. All right. Well, yeah, keep us in the loop on that.
Yep.
I appreciate the need to move with some pace, given rate environment and where things are and all the rest of that. But yeah, definitely, keep the committee in the loop rather than come back and drop it on us. So yeah, let's further that dialogue. But that said, I'm happy to motion the requested action as proposed to refinance the 2007 bonds.
Great,
I'll
with that
second.
motion, can I get a second? Great.
Second?
All in favor, say aye.
Aye.
All right, with no opposition, the motion carries. Thanks,
And
Adam.
just procedurally, just to let you know, we're going to issue the notice. We have to issue a notice to the bondholders that we will be calling, but the call won't actually be able to take place until the full board meets and approves. So, but we'll start that process now so that we can be in position to take it out as soon as the board approves.
Right, in December.
Thank you. Yes, in December, yes.
Great, okay,
Okay,
thanks.
thank
All
you
right,
very
next
much.
on the agenda is, thank you, Adam. I'd like to invite Doug McMahon, VP, Head of E-Mobility and Grid Flexibility, to present the next item on our agenda.
Okay, good morning, everyone. It's been a couple of months since we last updated the trustees and members of the public on the progress that we're making with our Vision 2030 strategic plan. And in March 2020, as part of our annual strategy submission, we're planning to request the trustees formally approve Vision 2030. So we've got a few months to go until that date. So we thought now would be a perfect opportunity to present where we are with the strategic plan and to solicit some feedback from our trustees as we look to finalise plan content and prepare ourselves for releasing the plan in Q1 of 2020. But before we open up for discussion, a brief update on where we stand with the plan today. So firstly, as you see behind me, our mission and vision. We introduced the proposed update to our mission and vision during September's trustee meeting, but I want to spend a few minutes explaining why we are proposing these changes. Our vision statement is a concise, aspirational statement of the world we're trying to create through the efforts of and actions of our business. And it reads, now proposed as a thriving and resilient New York powered by clean energy. So this, to me, perfectly describes the successful outcome of the two areas that NYPA is working towards, so stimulating the economy and generating clean electricity. Thriving talks to the healthy economy. Resilient is another aspirational word that we can use to describe the economy, while also making reference to NYPA's role as a steward of electricity reliability and asset security. Powered and clean energy, I think, are pretty much self-explanatory. Our proposed mission is subtly different to the one we approved back in 2014. It's very much the same structure and nomenclature, but with some impactful alterations that reflect not only our changing business environment, but the role NYPA is looking to play. So it now starts off with the word leading, which we feel is really important. It elevates the importance of decarbonisation, using the words carbon-free. It now places the customer in the centre of the strategic plan and our mission, both figuratively and literally. And finally, it includes the word responsible. And this is a nod to our historical role of stewardship, objectivity, and operational excellence. The second slide behind me. Sorry, comment?
No, I mean, I think it's incredibly well done, and we have very well positioned and needs to be in front of us all the time, so kudos. My only curiosity is how many hours you spent wordsmithing and editing and debating.
Don't ask.
Yeah, don't ask us to
Vision
add
and
up the
mission
meaning.
statements
Out
are
of
like,
it, but
you want to heading, okay.
a few
we're
hours
gonna
have gone
tackle
in, that's for
vision
sure.
and mission today.
More
So
than one.
kudos. Kudos for
Okay,
wrestling
thank you for that.
all the contrarian opinions. Great outcome. Very well done.
Thank you. Any other comments on the mission and vision from the trustees? Okay, so the second slide behind me summarizes the relationship between our customers and our proposed strategic goals and themes. I apologize, it's a little complex. Decarbonising our customers' electricity supply and wider energy needs will require, in my mind, three types of strategic investments from the authority. So firstly, the industry needs to decarbonise the generation of electricity, and with the right, albeit challenging, technological breakthroughs and commercialisation of these technologies, we have a good chance of achieving this in the next 15 to 20 years. And this is what our first strategic theme will focus on, cleaning the supply of electrons. Yet, we will not be able to achieve 100% clean electricity supply, and certainly not 100% affordable clean electricity supply without investing in the three strategic themes on the demand side. So those are the ones highlighted in blue. These three strategic themes will focus on helping our customers change the way they consume electricity, so as to ensure that we best align the consumption of electricity to the natural, intermittent, and cyclical nature of renewable energy supply. Investing in these three areas will not only reduce our customers' dependency on forms of generation that support short periods of peak demand, and these are typically the most carbon-intensive forms of generation, but it will enable our customers to consume electricity when renewable supply is most prevalent, helping with affordability. The final two strategic themes you see at the bottom there in orange and brown are necessary to build out the required NYPA and customer capabilities, tools and technologies to optimally manage a cleaner, reliable, affordable electricity system. And it's no coincidence that these are continuations of strategic investments that NYPA is already making in the areas of end-to-end digitization and workforce development. So through our ISOC, our recent ISO 55001 certification, NIM, and the rollout of Mosaic, we have made some incredible strides in these strategic theme areas over the last 3 to 4 years, but there's still more that needs to be done. One other brief comment on this visual. The customer is clearly at the center of everything we do, and this is going to be a theme that we see in Vision 2030. And we cannot achieve our strategic goals, which are the 3 square boxes at the top of the slide, without helping our customers achieve their goals. And I think that's a really important message that is fundamental to what we're trying to say through the Vision 2030 document. Any questions on this slide?
Doug, I have a question about the definition of who our customers are. Does this factor in the fact that there are investor-owned utilities in the state that have customers who want to move in this direction as well, or are they all encompassed in your definition of a customer?
So the answer to that question is yes. I mean, I think this is a sense of not only the direction that NYPA's customers are going to need to take, but other customers that perhaps NYPA doesn't directly serve, whether that's through the IOUs or through other forms of ESCOs. The CLCPA, the Climate Leadership Community Protection Act, is the same for everybody within the state, whether or not you're served by NYPA, an IOU, or someone else. So it is our feeling that this is the direction that all utilities are going to have to pursue as we look to make sure that CLCPA is achieved.
And just to add to that, I mean, we serve really all customer classes in New York, right? We have our agency, our government agency customers. We have munis and co-ops, which are ultimately serving the end consumer, right? Residential consumers across the state. And particularly under electrification with the Evolve program, with the building out of the charging stations, we're going to have essentially a direct line to individual consumers as well. So through these strategic themes, we're actually broadening our customer base and the individual all the way down to the individual level.
So I had a couple of questions as I looked at this, Doug, and I don't know how, and I'm sure it's captured in here somewhere as we think about, and it's to the point that you made that, obviously this is probably a direction that many of the utilities are going in as they try to satisfy a more demanding customer base who want clean energy, who want clean resources, who want a lower carbonized world. How are you figuring in, and where is it captured, this increased competition for the customers that we have? Not only from the other utilities, but other, sort of private entities. How is that captured in this strategic theme? How we will be more competitive to be able to offer this to our customers? Great that they're in the center of it, but how, as we look at this vision for the next, out to 2030, it is an increasingly competitive landscape that we will be operating in. How do we capture that as part of our vision of what we're offering as a more competitive approach to our strategic imperatives?
So that's the first
question.
There are a couple of areas where that's implied, and perhaps we need to make that a little bit more explicit. But certainly, some of the investments that we're making in digitization and on the supply side are there to try and make our electricity product as affordable as possible to the consumer. And I think a lot of the value of the digitization investments that we're making, not just on the generation side, but also on the customer side, are with that in mind, to work with our customers to make sure that they're able to achieve as an affordable and reliable and clean supply of electricity as possible. I also believe that a lot of the work that we will continue to do and evolve on the demand side, I think in particular in areas around flexibility, will enable NYPA to continue to provide competitive products and services to our customers. Because a big part of what we're going to have to do with our customers through this plan is to build flexibility in the way they consume electricity and also in the way that we provide supply, so as to make sure that they see us as the right people to work with. And I generally think that NYPA is in a unique place in the industry in New York to be able to deliver on this. There are very few entities that can do things on both the supply side and on the demand side to ultimately help achieve our customers' electricity needs. And I think that gives us a huge opportunity to demonstrate over the next few years.
Additionally, I might
And
also
that's
add
helpful.
that-
That's good to know. If we could also, I think it would also be important to tie in sort of our financing strength that we have to bring into different structures that we can provide to somehow capture that, again, being, ambitious and looking at this is supposed to be over the next 30 years. So if there's a better way for us to capture, I think it will be important for us to capture that competitiveness advantage that we have as part of this vision.
I agree.
Additionally, the
And
only
then-
thing that I'd
yeah,
add,
and then-
apologies,
Go ahead.
Tracy, but I wanted to say additionally, from a consumer value perspective, we acknowledge that the market's getting more competitive, and that's why we're placing that as a strategic goal, so that our focus is really on, like, from a consumer value perspective.
Great. And then the other question I have is you look at the digitization, which I assume is to cover, what we're doing, our investments around technology and to help us continue to be innovative and more competitive. How are you figuring it? And I looked at the next slide. Somehow I think it will be important, if this is to go out, that we include in there the element around security and data analytics. That we're incorporating into our ability to deliver these products to our customers in a way that our competitors can't. I didn't see, where that was captured. I think it will be important for us to capture that somehow, of how we're approaching this increasingly, non-secure world or insecure world, and how we are approaching that as we look at our digitization.
Great point. We have a section in the draft glossy which talks about digitization, but also we'll talk a little bit about how we manage some of the additional risks around, for example, data that's being shared across different entities and the like. So that will obviously play to some of the discussions and areas that we're focusing on in cybersecurity.
And then the last comment I had is we looked at, you've sort of captured the customer, you've captured our workforce, which is, I assume, the talent challenges that we will have, as every company has. The other part that I was curious about is how do we incorporate, because we do a lot of work around our environmental justice, the community aspect to what our vision is and how we're going to impact the broader community with the work that we're doing. We didn't capture that. Is there a plan to, or maybe I'm missing that? Where is that incorporated into how we look at how we're delivering our services and the impact that it has not only on our customers, which are important, and our employees through the workforce development, but also the community more broadly?
So that's not captured specifically in any of our strategic themes. It is obviously a big area that NIPE is involved in. We have we make reference to that in the Clean Economic Development Goal. That will also include measures around the impact that we're having on local communities and areas that require economic investment. So we have a goal, one of our 3 strategic goals, that touches on sustainability and environmental justice. And throughout the actual strategic plan glossy, you will see pages that are specifically focused on the impact that NIPA has within the regions in which it operates. So not just about the generation of clean power, but the jobs that we're helping to create, the investments that we're making in those local communities, and the differences that we're making. So we are acutely aware that that's a big part of what NIPA is about, and we are going to make sure that that's reflected in the actual plan itself.
Yeah, I think
Tracy,
it's important that we do that because, go ahead.
Tracy, I think those are 2 good points. I picked up a couple that you've great feedback. One on competition.
Yep.
Customer competition and many more energy solutions provider out in the marketplace, right? So where do we fit in that picture going forward? So we'll try and capture that in this plan. And second is in environmental justice and sustainability. Somehow we got to highlight it more in the plan. So we'll figure out how to do that.
Yeah, because I think it's important. It's a big conversation with every company right now. Is how do customers are important, employees are important, but how do we show the impact that we're having on the broader community of the work that we do? And I think we have a good story, and I think we need to put that front and center.
Especially in what's called disadvantaged communities who are more vulnerable to the projected impact of climate change.
Exactly. Great.
Thank you. Any other comments or questions on this slide? I've got one more slide to quickly run through, which just kind of talks about the structure of the plan itself. Okay. So as I mentioned, finally, a little bit more information on the proposed structure of the Vision 2030 plan glossy. We aim to lead off with a letter from the trustees and from Gil, one that lays out our vision and ambitions, but also makes clear the link between our current strategic plan and Vision 2030. We think that's important. This is the continuation of a journey. We will summarise the decarbonisation challenge and the link between it and a thriving New York State economy. We're going to outline what the electricity grid of 2040 will need to look like to accommodate all this clean electricity and what it will mean for our customers. We will also talk about the role that NIPA is already playing in the realisation of a carbon-free economy and the role we will continue to play in the future, and that touches on one of the pieces of feedback you provide us with. We will explain the value that NIPA brings to the New York electricity system and why we are well positioned to play a central role in the implementation of CLCPA. We'll also outline how we're going to work with our customers on their journey to decarbonising their energy consumption, how we will measure our success between now and 2030, so that's over the next 10 years, and finally what we're going to look to invest in through those strategic themes over the next 5 years. We aim to have a final version of the plan ready by end of the year, and I assume there'll be another brief update during December. Okay, so any other questions that you guys have at this point? Thank you for the feedback today.
Give us, Doug, a little bit of feedback on what's not in here, or how you rationalized, right-sized, appropriately focused here. Anything that should be further aired or debated in terms of what we could be doing, should be doing, might be doing, but just can't for some reason, real or perceived. Anything that landed on the cutting room floor that caused significant pain and consternation for enough of the group?
Great question. I guess some of that will come out over the next 3 months when we actually do a bit more of a deep dive into the strategic themes and talk about the specific initiatives and projects that we're going to look to invest in over the next 5 years. I'd imagine as we go through that process over the next 2-3 months, we'll end up with a series of investments that are continuations of things that we're already doing right now. Some new investment areas that we're going to look to potentially pursue given our new mission, vision, and set of strategic goals. And hopefully some areas that perhaps we want to dial back on a little bit as well, maybe not focus on so much in the future. So I feel that the strategic themes and the goals that we've put together are fairly all-encompassing and directionally correct, but the devil will be in the detail, and we'll be able to explore a bit more about that over the next few months between now and March when we come and seek approval of the plan from yourselves.
And building off a little bit of the earlier conversation, very impressive in all respects, but help me. You guys comfortable and confident that this puts us as one of the hunted versus one of the hunters? I mean, we're leading the pack versus chasing the pack. Give me some context from an industry standpoint. I realize we're constrained by geography, but we think of ourselves as more than a New York State entity, as an industry leader. So, help me a little bit with your collective comfort level with the strength of this plan relative to where the industry is and the industry challenges, and those your peers that will look at this and be impressed. The wow factor for the informed competitor versus the far less informed observer, such as myself. Give me some orientation as to where you guys think this continues to position NIPA as an organization.
I mean, I think it goes without saying that this is going to continue to position NIPA in a very strong light in the industry. You just have to look at some of the investments that we've been making over the last few years that I think really talk to the leadership that NIPA is demonstrating in the industry. Just 2 months ago, the ISO 55001 accreditation, the first electric utility in North America to achieve that. That's leadership. The $250 million that we're going to be investing in electric vehicle public fast charging. There is no other entity in the US that is committing to build out something like that. And I think as we begin to explore some of the new areas that we're going to invest in over the next few months and few years, I think you'll start to see that there's much more to come.
If I could just add, Chairman, if we look at all the strategic plans of utilities in our sector, they are all focused internally, inward, which is we're going to clean up our portfolio. We're going to be carbon free by 2050, right? That was, and if you look, almost everybody, it's inwardly looking. Ours is completely different. We're saying that we are going to help our customers decarbonize. So it's very much focused externally and to the customer. I think that's one very unique feature and will be a highlight of our plan. Second, aside from the EV investments, our investments in digital technology is by far so much more significant and I think smart compared to any other utility in at least in North America. And then Tracy pointed out something that I think we ought to highlight. Of all utilities, I don't think there are utilities with explicit environmental justice strategic plan like NIPA. I don't know of any other utility. So I think we need to put a spotlight and amplify what we're doing in the environmental justice, just transition, and sustainability space. We do that very well regionally and statewide, and somehow we gotta highlight that in our plan.
Okay, great.
Any other questions?
Great.
Thanks
No other questions. Thanks, Doug. Good job. You guys are going to come back to us. I don't know if you'll have further development at our December meeting, but this plan is to have this ready to launch in March of next year. Is that right?
That is correct, yes. Okay, thank you very much.
Great. No votes are required on this. If no other questions, the next joint finance committee meeting will be determined. I'll ask for a motion to close the meeting.
So moved.
Okay. Can I get a second?
I think you can second.
Dennis, are you there?
It's already gone.
We lost Dennis.
He closed the meeting. He was already closed.
Okay, so he obviously is in favor of closing the meeting since he's left the meeting.
Literally, his actions. He voted with his feet. He seconded with his feet.
Exactly. With that being said, motion carries. Thank you, everyone.
Thanks very much. Good job, team. Well done, Tracy. Judge, thanks for joining us.
Thank you.
Thank you.